Thanks everyone for joining today. My name is Nathan Davis. I'm a partner of Aspen Wealth Management as well as our Chief Investment Officer. And always enjoy having you here to join us for it. We've had a very quiet 2 years. In fact, I probably spent 7 to 8 of these quarterly market updates uh, complaining a little bit that there wasn't really that much to talk about because 2023 and 2024 were both very good, very quiet years for markets that, for the most part, just marched their way up a little bit at a time from the start of the year to the end of the year. And this year has definitely been a little different. A lot of uncertainty, a good amount of volatility. It has definitely been a change of pace from what we kind of had as a luxury for a couple of years, which was pretty quiet markets. Um, Uncertainty, volatility in markets is very normal. Having as quiet of a period as we did for a few years there was really more of the abnormal. But what we're going to talk about today, just to review where things stand, how what we've seen so far year to date, is go through a market review for the first quarter as well as year to date. I mean, really, the first quarter was pretty interesting, but everything that we've seen to start the second quarter has actually made the first quarter seem a little bit unremarkable. A lot of the volatility that we've seen has more so happened in the month of April. So we'll look at first quarter as well as what's kind of happened this month that has really changed the landscape year to date. We'll go through economic expectations like we usually do. A lot of that is going to be the uncertainty around economic expectations as it pertains to policy uncertainty, and just kind of waiting until we get a final answer, if we will get a final answer, on what things will look like for tariffs or government spending or monetary policy, what the Fed feels like they are obligated to do based off of any changes we see in inflation or unemployment. And then lastly, we always try and close out these meetings with implications for investors. So once we take stock of what's happened so far year to date, where we stand today, what we're kind of looking forward to for the next quarter or so, what do you actually do with that information as investors? We'll close it out with talking about some of our implications for investors. A quick look back at the first quarter and where things settled. Stocks were down. U.S. stocks were down just a little bit in the first quarter, um, down 4.72%, just under a 5% drop. How that's changed with as of market close yesterday, those losses have been extended a little bit further. The S&P 500 is down 8.23% year to date. But international developed stocks, emerging market stocks, and global real estate, while having lagged the US stock market for several years, at least so far year to date, have had a little bit of a change of pace and have seen positive returns that have added a good diversification factor to our portfolio. Same thing with bonds. There's been volatility in the bond market. Yields have fluctuated a little bit as policy uncertainty has fluctuated and therefore inflation expectations have fluctuated. But US bonds are up so far year to date. It's come back a little bit. It was 2.8% by the end of the first quarter. I have like the best estimate now through the end of the month is that they're up 1.8% year to date. So still up, but have given back some of the gains with the volatility we've seen the last couple of weeks. Global bond market is still seeing some struggles. We're starting to see interest rates rise across the globe outside the US, just at a lag from what the interest rate increases we saw in the US largely in 2022. And then as some of those increase work themselves through the yield curve in the US and into 2023, we're starting to see more foreign countries start to follow suit. It's just been a few years late compared to where the US was. Looking out just a little bit further, the long-term summary, kind of looking out for the last 12 months and beyond, we are still seeing a whole lot of green. Like I mentioned, 23, 24 were really quiet, really good years. We are off all-time highs, but we still have experienced quite a bit of growth in the last year, the last 5 years in particular. The only asset class that we really follow that for any extended period of time has not provided positive returns for investors is the U.S. bond market. Even over the last 5 years, it's down 0.4% per year for the last 5 years. And that's just, will just continue to improve as we get further and further from 2022, where the price depreciation was pretty extreme in US bonds as interest rates rose. Every year that we get further away from that is more years that we've had the benefits of higher rates. Anytime you go from low to high on interest rates, it is a painful period, but investors do ultimately reap the benefits of that in the long run when you are a bond owner in terms of receiving higher yields. So the last 20 years have really been exceptional across all asset classes. As we mentioned, US stocks have outperformed their international counterparts. They've outperformed emerging markets. But looking at the last 15 years, 10 years, previously, we had been seeing well above average returns in these asset classes. That has come back down a little bit. For US stocks to be at 12.76% over the last 15 years, 11.8% for the last 10, depending on what metrics you use, there is about a 12% expected return, a long-term average for the US stock market. At one point, by the end of 2024, it had been, 15% average returns over the last 10 to 15 years, which was abnormally high. So the correction that we've seen so far year to date still has us trending above average growth for the last 10, 15, and then kind of close to right on average for the last 20. But overall, we've still seen phenomenal returns in US stocks, lagging returns, international and emerging markets. But they still have their diversifying benefits. They still have a place in the portfolio, and we'll discuss that as well. Just to look back at some of the headlines, and as I said in my opening, a lot of these headlines now seem a little bit unremarkable considering everything that we've been through with our markets just in the month of April. But one thing that we want to be mindful of, we are always keeping an eye on the news. We're keeping an eye on data that's coming out. We're keeping an eye on developments. But these headlines are not offered up in a way to explain market returns. They just serve as a reminder that investors should view daily events from a long-term perspective and avoid making investment decisions based solely on the news. Because you can see here in succession, you get bad news, you get good news, you get good news, you get bad news. It is a constant fluctuation back and forth. It is a 24-hour news cycle as it pertains to financial markets and really all news. And it's, the next inflation print that we're waiting on, the next Fed meeting, the next earnings release, it can all feel so important. And then it passes, it's quickly forgotten, and all anyone cares about for the talking heads is the next one all over again. Doesn't mean that we're not going to talk about what the next inflation print may be, what the next Fed meeting may signal. We always want to be aware to see if we can identify longer term trends. But there's no one meeting, there's no one data point, there's no one headline that should lead to a change in your overall long-term strategy and your long-term philosophy. This is a chart I haven't had to break out in a few years, but it serves as our reminder that, just because in hindsight, we track all market performance from a January 1st to December 31st. Hey, how was performance in that calendar year? Doesn't mean that within that year, from top to bottom, we don't ever experience intra-year declines. On average, there are intra-year drops, so relative peaks to relative bottoms as we make our way through the year, on average of 14.1% in any given calendar year. This is looking back calendar year by calendar year. Where did the market end and what relative intra-year drops did it experience at any point in time? Some good examples of this are looking to 2020 and looking to 2021, where 2020, we saw a 34% slide in 3 weeks at one point in time, just for markets for the end of the year to end up 16%, the S&P 500. Looking at years where we've had 8% declines at one point in time, but we were able to finish the year 27%. So intra-year volatility occurs every year. It's on average 14%. This year, our worst top to bottom relative decline has been 19%, just bumping up against bear market territory. Right now, this is as of, I guess not yesterday's market close, but as of Tuesday's market close, down about 10% on S&P 500. But just because we see volatility from relative highs to relative lows throughout the year does not mean that we don't have the opportunity to end the year on a positive note. 34 out of the last 45 years, we have seen positive returns in equity markets. In every single one of those years, we have seen some sort of intra-year decline, a period in time where it felt like things were pretty rough. Changing gears a little bit to, look at what is leading to some of those headlines, what's leading to some of that volatility that we just looked at. Overall, coming into the new year, the U.S. economy looked really strong. Momentum appears to have faded during the first quarter into where we are today. But to understand why economic activity has been so resilient and why it has slowed and where it is headed, there's a few of these different components of GDP growth that we can analyze. This chart, it offers us a closer look at the key drivers behind recent GDP growth. And, given that consumption accounts for almost 70% of the U.S. economy, it's no surprise that the health of the economy is closely tied to that of the consumer. Supported by impressive gains in household wealth and 22 months of positive real wage growth, consumer spending has powered the economy forward, rising 4.2% during the fourth quarter. When we look at business fixed investment, so the corporation side of the consumption equation, business fixed investment slowed after a string of strong prints, and that's likely reflecting the lagged impact of higher rates, while residential fixed investment improved after 2 straight quarters of declines. So we have seen some back and forth in some of these different components. The recent decline in mortgage rates, which has been a positive, suppressed level of housing starts in 2024, suggests that there's some room for revival in the housing market after what's been a little bit of a slump. Sudden, plunge in immigration could impede housing demand. It could impede some of the building activity, but overall, with one of the goals of, managing these tariffs and getting, more of a focus on the U.S. economy, one of the levers that they're hoping to pull is to reduce rates in the mortgage market and make housing more affordable. It is possible that we continue to see that through the end of the year. Government spending, the treasury side, the budget side of the consumption equation, has definitely helped boost growth in recent quarters. So that said, very much one of our major headlines today is budget cutbacks, that could limit meaningful support from federal, state, local government spending in the months ahead. Uncertainty there. Policy overall is casting a little bit of the fog on the economic outlook. Not to say, fog is in good or bad, but it's making what's already a very difficult forecast and prediction process just even more difficult, with not knowing exactly what policies we're working with, being in this transition period. Recent data, has shown a huge spike in imports that's likely driven by businesses trying to front run tariffs. Should those imports remain elevated, it's possible that we get a negative print on the first quarter of 2025 GDP due to a drag from net exports. Kind of quick stop back in Econ 101 with our GDP refresher, gross domestic product. The functions of our equation, using what's most commonly used is the expenditure approach, what money is being spent and where. We have consumer spending, business investment, government spending. And then as the tariffs pertain to things is the last part of the equation, which is exports minus imports, also known as net exports. Are we collecting money from overseas for the products that we create and sell, or are we sending our money overseas to foreign produced goods, anything that's produced abroad? So when imports rise significantly, even if consumption is strong, business activity is strong, it subtracts from the GDP formula. So when, imports are goods and services, when they're not produced domestically, even though a U.S. consumer is buying that good, the value doesn't count towards U.S. production. It's netted out through that exports minus imports function. If imports spike, for example, all of these consumers are worried about foreign goods being more expensive than they used to be, and they're front loading a bunch of those purchases, trying to get them out of the way now. It could lead to a really sharp jump in those imports, trying to get them ahead. And using that as the one negative part of our equation here, it could lead to an on paper negative print for GDP overall. Still, there's still a lot of uncertainty around this. We will get an initial estimate of first quarter GDP next week, but it takes multiple revisions to get anything close to a real figure for this. We get a first estimate next week. A month after that, we get the second, slightly more accurate on May 30th. And then we do get a final estimate of GDP for the first quarter about the end of June. So still remains to be seen here. But it is possible that we see a negative print on our GDP coming up here soon, just as expected. Consumers front load some of their purchases from overseas, trying to get it in before any tariffs. Last closeout on the components of GDP here. So there's been weaker vehicle and retail sales through the end of February. And that does point to a potential slowdown in consumer spending. But it's a slowdown from a fourth quarter pace that was well above trend. And so we're also experiencing right now consumer confidence falling to multi-year lows. So we have some pros, we have some cons as it pertains to consumer spending. Overall policy uncertainty is going to weigh on most of those potential outflows, most of that spending. We're just gonna, wait and see what happens. It's unclear if a slowdown is, if it's a start of a back to trend growth since we've been above average. It's tough to tell if a slowdown is the beginning of something more challenging. We're just gonna take the data as it's presented to us and continue to look forward to the long term. So looking more towards components of stocks and what are the sources of earnings growth? What are the sources of profit margins for U.S. publicly traded companies? The S&P 500 had its cumulative earnings grow by 10% in 2024. That was capped off by an impressive fourth quarter earnings season that saw earnings rise roughly 18% year over year, 5% quarter over quarter. Margins were the key driver here, so contributing over 13 percentage points to that overall growth number. Beneath the surface, earnings continued to broaden, which is good. We've talked a few times in the past how the Magnificent Seven, those top 7 companies in the S&P 500, were not only providing the lion's share of the positive performance for the S&P 500, but even when you looked at the underlying data, something like earnings, they were generating the most of the earnings for the S&P 500 as well. The earnings have continued to broaden. There are more companies now positively contributing to that earnings function for the S&P 500, where now all of the S&P 500 companies, excluding the Magnificent Seven, have now had their earnings rising 15% year over year. 10 of the 11 S&P sectors contributed positively to earnings growth, which was led by financials. So this trend should continue into 2025. And in this instance, and a lot of instances of what we'll talk about, It's kind of a bifurcated path. There's, hey, what is the macro environment and all of this data that we've had kind of up until tariff talk? And how could all of this be completely drastically changed once we get to the, culmination of what tariff life is going to look like? So it is a very much a fork in the road, and there's two very different potential outcomes. But independent of the tariff talk, the earnings growth trend was very much expected to continue. So at least we're going into tariff talk with pretty strong financial balance sheets. Um, Analysts are projecting even stronger growth for 25 and 26 than we had in 23 and 24. Originally, projections had been about 11% for 2025, and then growing even further, 14% for 2026. Uh, Definitely a little bit on the rosy side. Earnings are cyclical. The long-term average for earnings growth of S&P 500 companies is 7.3%. Where a lot of the rosy outlook comes from is really contributions from AI. We do very much have a changing demographic of our workforce. The amount of workers that we have is directly tied to the productivity of our economy. But while I would say that, sentiment has slowed a little bit on AI as we're now kind of a year or two into the broader AI adoption. The potential that it has for increased productivity of all of the remaining workers we have in the United States very well could be a factor for many years of above long-term average growth in earnings. Each worker that we have being able to produce more and more with the assistance of AI is very much a regime changing implication where it could very much just be a new normal, almost like a new economy. But, against this backdrop of increased uncertainty, markets are already sensitive. Companies that fail to meet expectations um, have been getting punished more than usual. So the companies have to release their own estimates of what revenues are going to be, what earnings growth is going to be. As we said, the market participants anxiously await what those actually earning results are as they are released. And we have seen quite an uptick in volatility post earnings announcements, where it just seems like investors are hanging on to those expectations pretty closely. And really, I mean, we've seen some stock prices just get absolutely punished for small misses on what their expectations are. And so in times like this, investors can use active allocation, active management to play defense in their portfolios. That it looks like limiting exposure to companies that are burdened by these elevated valuations and expectations. Focus on underappreciated companies that are less susceptible to market sell-offs. Focus on the mid to small cap space of our U.S. investment universe, where you are reducing your concentrated exposure to just the largest tech companies that we have here. So it's been uncertain, it's been volatile. We have seen a lot of wild reactions to seemingly small misses in earnings. But there is something as investors we can do about it, and it's just increase our overall diversification, not allow ourselves to have the concentrated exposure that a market weighted index, experiences right now. Fleshing out the inflation side of things a little bit more. Inflation overall is still well below its cycle peak that we experienced in 2022, June 2022. We reached a peak of 9.1% inflation. It is very nice to have that almost 3 years in the rear view. Overall, headline CPI has been coming in better than expected in February and in March as well. March data was only really just released. We have more of the top line than we do the component data. So a lot of this will focus on the February components, even though we do have an overall March inflation number. But February, March, headline CPI came in better than expected. We had 2.8% year over year. in February compared to 3% in January. And then March data that was just released was at 2.4%. That returns to the recent low that was set back in last September before we had a few months of seemingly trend reversal. We are now back to last September's previously recent low as it pertains to inflation. We do still believe that underlying price pressures are easing, but come spring, the effects of tariffs could push inflation higher. Core goods prices were a steady source of deflation throughout 2024. In recent months, however, prices have moved higher on a sequential basis. New and used vehicles are largely to blame, with prices likely being pressured by increased replacement demand following recent hurricanes, wildfires, everything like that. On the more volatile components, which is largely for us been energy and food, inflation for both of those has been running hotter recently. February and March, they both did ease for us a little bit. So with tariffs now, we'll get to tariffs more in depth next, but with tariffs now having been imposed on China, Canada, Mexico, it more likely to come. This is an ever evolving situation for sure. We could see prices rise meaningfully in the month's end. Elsewhere, shelter, auto insurance, all of those have remained key contributors to inflation. Shelter itself is over a third of the CPI basket. While showing signs of easing recently, it has held stubbornly above its pre-pandemic trend. That said, real-time measures of market rent, which are measured slightly different than the owners' occupied estimates of what they would, if it's I own this house and here's what I would rent it for, and that's what largely flows through to CPI here. It does seem like with some of the real-time measures that rents are pointing towards more normal levels of shelter inflation ahead. We've also been told that multiple times over the last 6 to 8 months, and still have seen just sticky shelter inflation. Auto insurance has backed off a little bit, but it still rose 12% year over year in February. So fortunately, as last year's rollover in vehicle prices feeds through some of that data, the trend should continue to fall, while progress on disinflation. It's been encouraging that that last leg, looking at inflation cumulatively, the entire CPI basket. The Fed has a 2% target, and that last leg down to 2% could prove more difficult. Was already proving difficult, but it could prove more difficult due to tariffs. In fact, based on what we know about the tariffs so far, while there has been some that have been announced, some that have been walked back, some that have been modified, and then many of them which have led, to more negotiations, which was a big motivation for the tariffs themselves, was to negotiate long-term trade deals. What we know about tariffs so far, inflation at or above 3% by the end of the year is very much not out of the question. If, as tariffs exist today, proceed through the end of the year, we could see a reversal in CPI back to or above 3% by year end. So a little more on tariffs. Over time, economic globalization has led to increasingly relaxed trade policies. That the average tariff rate on U.S. good imports has steadily fallen since the 30s, with our trend line here. However, geopolitical tensions and supply chain snarls induced by COVID have prompted a reevaluation of many of our open trade policies. With promises to protect American businesses and address unfair trade practices, tariffs sit at the center of President Trump's administration's policy agenda. This graph kind of helps put some of those recently imposed tariffs into context. Those headlines on tariffs are changing literally every day, and sometimes multiple times a day. Tracking them can be difficult, and that's probably an understatement. But at the beginning of the month, President Trump had signed into effect 25% tariffs on Mexico and Canada, excluding energy, with a 10% tariff on specifically Canadian energy imports. And at that point in time, it had been an additional 54% tariff on China. Um, he had also put into effect 25% tariffs on steel and aluminum in an effort to benefit domestic producers of steel and aluminum. Many of those have been paused. Many of those are actively in negotiation. Some have had back and forth retaliatory changes. I mean, China, which at one point and then possibly still at the moment, maybe it's changed since I've been talking, or at least in the last day, China's at 125% at one point. Considering the tariffs that are already in effect, we would estimate once all is said and done and all shakes out with where things are in process today, that the current average tariff estimate for it on imports to be approximately 18%. That estimate for average tariffs was 8% about 3 weeks ago. So it's very much a developing situation. That 18% is where the current estimate stands by year end, is up from 2.3% in 2024. And it's the highest effective tariff rate that we would have since the early 1970s. As we've said multiple times already, trade policy remains highly uncertain. It is unclear what will be implemented permanently, what will be used as a negotiation tool. Regardless, tariffs have risen. They're likely to rise further under the new administration. It's a priority of theirs. Beyond discouraging imports, tariffs can have a negative unintended consequences. They could lead to higher inflation, trigger retaliation, as we've seen a little bit with China so far. They can reduce demand for U.S. exports. Overall, aggressive tariffs are adding even more uncertainty to an already foggy economic outlook, complicating the Federal Reserve's path forward. It seemed like the Fed had been managing inflation, managing employment the way they wanted to. We were on a path. There's just now more uncertainty. But, it is possible to have tariffs and not have inflation as well. One of the more recent examples is 2018, 2019 with China again, U.S.-China trade tensions. A lot of that, the focus on that was consumer electronics. Consumer electronic prices stayed flat. In many cases, they even declined, even though tariffs were put in place. And it's because there are macroeconomic, inputs to this outside of just the tariffs themselves, specifically to 2018 to 2019. As the dollar strengthens, it is easier for Americans to buy goods outside of the U.S. with a strong dollar that goes further abroad. And so even if there are tariffs that on one end of the balance beam or one end of the seesaw are increasing prices overall, as the dollar becomes stronger, it offsets things on the other end. It makes it easier to buy, foreign goods. Overall, just deflationary trends. Tech, when you look at what it costs you to buy a big screen TV in 2005 versus 2025, you get way better technology today, and it costs way, way less. And as AI becomes more and more applicable, there are certain deflationary trends that could help offset the impact of some of these tariffs as well. Supply chain diversification. Absorption, as companies are combining mergers and acquisitions, bringing production back into the United States for certain goods. All of these are reasons that we could possibly see tariffs not have a considerable impact on our inflation domestically, but it still just absolutely remains to be seen. We're gonna monitor, and we'll see how things go. All right, so taking all of that and tying it back to the federal budget, federal finances overall. So among other expansionary fiscal policies, the Trump administration has expressed its intent to fully extend the Tax Cuts and Jobs Act, TCJA, and reduce the corporate tax rate. It has also promised to dramatically cut costs. in determining whether these policy proposals are feasible and how they could impact the fiscal health of the U.S. We have a few charts here to kind of help break this down for us. The chart on the left shows the CBO estimates for government spending of where that budget is going to go by section, and how the spending will be financed in fiscal year 2025 to reach our cost-cutting goals. The administration may have to make some difficult decisions. So non-defense discretionary spending accounts for just 12% of the government's budget, meaning that they may have to explore spending cuts on defense or adjustments to entitlements. Initial efforts. The Department of Government Efficiency, DOGE, is in the headlines all the time as well. So initial efforts have focused largely on federal workforce reduction to cut costs. The extent of federal layoffs is still largely unknown. Their cost savings will likely be negligible. We estimate overall that less than 6% of the budget went towards federal employee compensation. So when you figure it's a fraction of employees that are getting laid off of an already small percent of the federal budget, the ultimate reduction in government spending based off of that, it really may not amount to much. Administration has also expressed its intent to use tariff revenues to help offset the extension of the Tax Cuts and Jobs Act. So, however, tariffs are just a sliver of current government revenues. Even if we do see, like we looked at on the last slide, a large increase in tariffs, it's still likely to remain the case that tariffs are only a sliver, very slight amount of government revenues overall. Higher tariffs, by possibly inviting retaliatory tariffs, could slow the economy. It could reduce revenues from other areas of income taxation, all things that we need to be mindful of. And with our charts on the right, so we explore the outlook for the deficit in the federal debt. With no revenue or spending offsets, the Tax Cuts and Jobs Act is likely to amount to significant stimulus and to add to our deficit. And that has been a big motivation for this Department of Government Efficiency of attempting to balance the budget for the first time in a very long time, manage the deficit. Every year that we operate with a federal deficit, it just gets added to our overall debt. Something's got to give somewhere. And that the overall amount of federal net debt is shown on the bottom right. According to the CBO, federal debt is expected to climb to nearly 120% of GDP by 2035, excluding the impacts of the Tax Cuts and Jobs Act extension. And with the inclusion of the Tax Cuts and Jobs Act extension, possibly to as high as 130%. That is up from 98.2% in fiscal year 2024. So since the TCJA extension and any additional provisions will need to be passed through the once-a-year budget reconciliation process, right now it seems unlikely that they'll be wrapped up and go into effect by the end of this year. Unfortunately, right now it seems more on track that they'll go into effect early 2026 for the 2026 tax year. So, that said, a slowdown in economic activity could prompt additional fiscal stimulus before then. Not only would expansionary fiscal policy boost deficits, but it could also act as a longer-term source of inflationary pressure that we just discussed. So back to the Fed, interest rates, and the difficult job that they have ahead of them. The Federal Reserve finds itself, in an unenviable situation heading into the second quarter. So they delivered 100 basis points of rate cuts in 2024. Fed has been confronted by slowing economic activity, stalling disinflation progress in early 2025. As we said, the last 2 months at least have been a process of kind of removing that stall. We are getting back to lower prices, at least to this point. But the committee certainly has a preference to continue easing policy until it reaches a neutral stance. However, fiscal stimulus, in addition to tariffs, immigration policies, all of this could could make it very difficult to achieve that neutral stance. As expected, Federal Reserve voted to maintain the Fed funds rate 4.25% to 4.5% at their last meeting. With tariffs top of mind for them, the updated summary of economic projections that they provide reflected expectations for slower growth, higher inflation in the near term. 2025 growth forecast was downgraded from 2.1% to 1.7%, while headline and core inflation forecasts increased by 20 basis points and 30 basis points, respectively. So they do feel like the tariffs as proposed in the short term, with emphasis on in the short term, a slight downgrade to growth, a slight increase to inflation. But further out, the Federal Reserve, their inflation forecasts were largely unchanged. So it does suggest that the Fed, at least for now, expects any inflation impulse from tariffs to be transitory. I hadn't seen that word in a while, so everything that popped up of transitory is flashbacks to all of the inflation we saw at the onset of the pandemic, where we were just waiting for it to go away, and it spent months and months and months not going away. But we're back to transitory. So the Fed does believe that it is a short-term hurdle that we have to get over as it pertains to growth and inflation with the tariffs as projected. With, for most part, left things unchanged for the midterm and the long term. The average open market committee Fed member still expects 2 rate cuts in 25, 2 rate cuts in 26, and then likely one more in 2027 to get back to their neutral rate. Turning to the balance sheet, the committee announced that it would slow the pace of quantitative tightening. So we spent years and years and years with quantitative easing. The Federal Reserve was injecting cash into our economy, into our markets by, buying up treasuries, buying up mortgage-backed securities. We are now in a opposite period of tightening where they are trying to reduce that balance sheet, which, puts bonds back out into the marketplace. And takes cash back. So they've slowed the pace of their quantitative tightening, but they still do expect they have a redemption cap, was lowered from 25 billion to 5 billion. And then the mortgage-backed security cap was left unchanged at 35 billion. So these adjustments do support the Fed's efforts to get back to an all treasury balance sheet. Today, markets are pricing in just under 3 full rate cuts in 2025. So markets are expecting one more rate cut than the Fed themselves are expecting. But it's likely an average of 2 scenarios being weighed by investors. Like we've talked about how there's what life looked like prior to tariffs, what life could look like with the tariffs, and being a fork in the road of 2 different things. The market forecasting 3 rate cuts is kind of on average. Do things get really bad? Do things stay really good? Feels 50-50 on which one it's going to be as we wait for tariffs to work themselves through the system. So largely the main reason that there's a difference between investor expectations from the Fed themselves. And lastly, should inflation remain elevated, in the economy resilient, the committee could deliver just 1 to 2 cuts this year. On the other hand, a more serious growth downturn could prompt more aggressive rate cuts. All this said, the ultimate impacts of government policy are still unknown. Pace of rate cuts will continue to hinge on policy developments, on incoming economic data. In that regard, things haven't really changed. The Fed has been in a wait and see policy for over a year now, where they continue to see what inflation is, what unemployment is, and what our GDP, what our growth has been, and they take the information as it's presented to them, and they announce their changes. So, conceptually overall, that hasn't changed too much. Back to markets a little bit, looking at the S&P 500 and looking at some of the valuation measures. So, despite strong earnings outlook, as we discussed a few slides ago, with analysts' estimate for kind of a pretty rosy picture, possibly overly rosy picture of what growth expectations are, earnings expectations are. There has been elevated uncertainty at elevated valuations. as a significant risk for U.S. equities. The concentrated rally of the past 2 years, back to I felt like I had 8 quarters of updates where there was nothing really going on. We talked about the concentration in U.S. stocks multiple times through that period. That concentrated rally of the past 2 years has left the market with plenty of room for correction. And we have seen quite a bit of that correction already. S&P 500's had a rocky start to 2025. We mentioned the 19% drawdown at one point from the highs that we saw in February. But with this sell-off, the next 12 months price to earnings ratio is now just under one standard deviation above its long-term average. Other valuation metrics, like something like price to book, price to cash flow, looking at a company's balance sheet relative to what it has coming in, relative to what the price of the company itself is trading for, all of those metrics are similarly elevated as well. The Magnificent Seven are responsible for a large portion of this distortion. They're responsible as well for a large part of the recent downturn. When we said that after the most recent market close, the S&P 500 was down 8%, the NASDAQ, which is largely represented by those tech names, those growth names, the NASDAQ had been down about 13.5% at that point in time year to date. So the Magnificent Seven has been very much responsible for being a large portion of that recent drawdown. But there's a lot of companies in the United States, even above and beyond the 493 that are in the S&P 500 that are not the Magnificent Seven, not to mention all the other publicly traded companies we have in the United States that fill out the rest of that approximately 3,500 publicly traded companies. There's a lot of these companies are profitable. Some very much are overvalued, overowned overvalued, overowned. But many of them can benefit from AI. They can benefit from technological change. All of those factors are unpredictable. They're disruptive in a good way. And so it just goes back to there's a lot more companies that you can invest in this country than the Magnificent Seven. And many of them have phenomenal opportunities for the future. The new administration, has been a source of uncertainty with the tariffs, the taxes, the deregulation. For the most part, though, they haven't fully crystallized into policies. It's very early stages of discussions of executive orders. And so the opposing effects on profit margins of how the bottom dollar for these publicly traded companies are actually going to be impacted, it's all tangled up. It's difficult to really separate what from what. And AI policy driving U.S. equity markets, but overall the destination's not clear. What we should do as investors, we should ensure that our portfolios aren't overexposed to the most overvalued parts of the market. We should make sure that we are considering the formerly unloved parts of the market to reduce impact that a broader down could have on portfolios. And a perfect example of that, going back to our first slide of the day, is something like non-U.S. markets. Diversification can be hard sometimes. That does bring us to our next slide. As the U.S. outperformed the rest of the world for 10 plus years. But diversification means that not everything in your portfolio is always moving the same direction at the same time. There are lots of benefits of owning parts of the global economy outside of just the U.S. What we've seen year to date, while short period, has been a reminder that a little bit more global equity market dynamics have shifted quite a bit during the first quarter. International stocks surged ahead of the U.S. Since the widest margin since the 1990s. So weak expectations for international markets had for many quarters led to depressed valuations. When we talk about earnings growth, when we talked about price to earnings ratios, in our very quiet, boring 2 years where I was always struggling to find things to talk about, that was a common mainstay in those presentations of valuations are very attractive outside of the United States as well. Low expectations, low valuations had, previously set the stage for this rebound. And it has reminded us as investors that valuations still matter. US's share in global market cap is very much still near record highs. We see that in the top right, at 65% of the global market, after, as recently as 2007 being 40% and 87 being 30%. So, very much still near record highs for global market cap. But this reminder for diversification is as important now as ever. Many international economies continue to face cyclical challenges. Sector trends are driving powerful returns. Things like European and Japanese banks haven't done anything for a very long time, and we are finally seeing that they've been awakened, and we're seeing positive growth and positive forecasts on the backs of higher interest rates and fee income. They've been among some of the best performing industries globally year to date. Meanwhile, European defense and aerospace stocks have jumped on the back of an 800 billion euro defense spending package announced by the EU. All of these things that are in economies that are adjacently impacted by our monetary policy and our fiscal policy, but very much still operate under their own considerations. China is still stuck, in a cyclical bog. Its tech sector has seen strong returns due to better earnings, enthusiasm for AI innovation, as they directly try to compete with us for AI dominance. Obviously, the tariffs as announced specifically targeted on China have a wide range of outcomes for what markets in China are going to do over the next couple of years. But, overall, sectors that benefit from the growth of the emerging market middle class, like Indian consumer discretionary, European luxury goods, all of these factors outside of the United States just continue to appeal to investors. Breaking it down a little bit more, on the left-hand side of our chart, the dollar's recent decline has boosted US dollar returns for a range of markets. And so just as US equities were overvalued, so is the dollar. Investors should always be aware of how currency fluctuations can impact their international equity holdings. Although investors have benefited from overweighting the US in recent history, the tide can always change. We're in times of increased uncertainty. Investors can play defense by diversifying their equity exposure across global markets. And plus, an active investment strategy looking at those asset allocations, active meaning depending on what benchmark you're looking at. Many U.S. investors focus only on U.S. markets. So in their instance, being active is allocating anything to the rest of the world. If you operate off of a benchmark that is the global market portfolio, similar to that top right chart with the share of global market cap, being at 35%, the rest of the world has you neutral, but at least you're more diversified than a U.S. only investor. Diversifying that equity exposure across global markets can help sidestep some of the, risky or lower quality companies, which ultimately sidestepping companies like that unlocks the potential for higher long-term expected returns. So this, in summary, takes us all to our implications for investors. The closeout of that was a whole lot of information. There's a lot of uncertainty. There's a lot of divergence we could see in our expectations going forward, based on some of the policy announcements that we're willing to see. We as investors, what do we do with all of that information? How should we consider our portfolios in light of all of this? The best summary comes down to effectively three things. We want to focus on patience over impulse. We want to manage our tariff-driven inflation risk, and we want to focus on global diversification. I really like this quote from Eugene Fama. He's a professor at University of Chicago Business School, Finance Economics. He's the father of the efficient market hypothesis, the multi-factor model that was the result of the small cap premiums, value premiums, profitability premiums. All of these things that emphasize how prices incorporate information quickly it's hard to gain an edge without time or risk. But he has this quote that the market is a very efficient mechanism for transferring wealth from the impatient to the patient. The quote highlights that most investors underperform not due to their asset selection, but largely due to their behavior. In today's fast-moving markets, we have our AI hype cycles, we have interest rate uncertainty, we have geopolitical news. It's very easy to react when, in a lot of cases, reacting to this news at all tends to be negative, more likely than positive. The investors who focus on fundamentals, they stick to the plan. Those are the investors that tend to benefit the most over time. Any of those behavioral mistakes, if we are buying high and selling low, generally, even if somebody doesn't know anything about markets, they know that when you buy something low and you sell it high, that's a recipe for success. Behavioral mistakes like doing the opposite, buying high, selling low, it just erodes our returns for the long term. We want to make sure we're sticking to a plan to avoid those behavioral mistakes. For managing our tariff-driven inflation risk, tariffs are rising, it's fluctuating. Fed policy is getting harder to forecast. Overall, what we want to do with this, similar to the have a plan for cash conversations we've had in the past couple of quarters for our implications for investors, is with our tariff-driven inflation risk, we really want to look at the fixed income side of our portfolio. Fed policy is harder to predict as this potential tariff-induced inflation could create a dilemma for them. And so when we're looking at our fixed income allocations, we really want to focus on shoring up the short end of our allocations, anything from 3 months to 3 years. The inclusion of inflation-aware positions, something like TIPS, inflation-protected securities, Treasury inflation-protected securities, that help us against a surprise to the high side for inflation. Selective real asset exposure, something like real estate. All of these things can help us preserve purchasing power and reduce interest rate risk. If you are an investor, particularly one who is taking money out of your portfolio rather than putting money into it, we want to have a really good plan of what in your portfolio is providing you your income for the next 5 years, regardless of what equity markets do for us. And that is the implication for investor for managing that tariff-driven inflation risk, getting that short end part of your fixed income portfolio right to allow for equity markets to be volatile and to have it not impact you as an investor. You've got the near term covered. Our last implication for investors with the global diversification, just a reiteration, international stocks for the first time in a long time did outperform in the first quarter. As a reminder that global investing can pay off when U.S. valuations are stretched. There's been very much a valuation gap where U.S. equities remain expensive even today after the pullback. International markets are trading a little bit more at a discount rather than a premium, and it can offer better entry points for long-term investors. And then lastly, this is that currency tailwinds matter. Many investors just hedge out their currency risk. They technically have no exposure to it at all, whatever the dollar does relative to baskets of currencies. Always good to confirm that that's the case, because if it's not, it could drastically change your ultimate returns without intending to. Usually people don't want to target that currency exposure. They just want to get the foreign returns independent of any currency moves. But those currency tailwinds do matter. A weakening US dollar boosted returns for international investments in the first quarter. And currency moves are unpredictable, but they can enhance returns when diversified globally, particularly around tariffs and whose goods are being bought by whose citizens and where is that imbalance of trades moving. A great way to have some exposure to that and benefit from it is global diversification. Well, that is it for our presentation today. As always, there are a lot of generalities that we have to talk about in these presentations. But generalities don't matter to you as individuals and investors. All of your circumstances are very much unique, they're different, and they have their own considerations. So, if there's anything here that triggered questions, concerns, changes to financial plans or anything like that, please don't hesitate to reach out. We are here to help. We want to make sure that your unique circumstances are being evaluated when it comes to things like those implications for investors. Call the office. You can contact us via email. And appreciate everyone attending today, and look forward to maybe my next presentation will be back to nothing interesting happening, and I'll have to work really hard to find things to talk about, but we will just have to wait and see. Thank you.